Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
And today we're going to chat about how to get a mortgage. And so we are here with our go-to expert on all things home finances, Steve Farrington from Loan Depot. How you doing, Steve?
I'm doing awesome, Scott. How are you doing today?
Excellent. So tell us about yourself.
What do you want to know?
Everything. No,
Everything.
we don't have that kind of time.
We've known each other quite some years, so you know a lot already. But gosh, I got into mortgage and finance in 1997, so 24 years ago now. I've done all facets of home finance, whether working for a retail bank, doing equity lines, purchase money. I've done wholesale lending. I've had my own mortgage broker shop. I also took a hiatus because I got, I wouldn't say bored of mortgages, but I wanted to challenge myself, and I went into the finance market, worked as a licensed finance professional with Vanguard and also with Merrill Lynch as well for several years, and then got back into mortgages about 5-6 years ago now.
Which gives you kind of a unique perspective compared to the typical loan officer as far as understanding building wealth, investing, as
Absolutely.
well as purchasing a property, which for most Americans, quite honestly, is their really biggest nest egg, their biggest source of retirement funds and that kind of thing, which, you know, is a good thing because, I mean, housing is, you got to have a roof over your head.
Right.
At the same time, leveraging your money and, man, talking about today's rates and things like that, it's difficult not to look at all your options. So I think the one big benefit, and I'll let you talk, is is the kind of the two-prong approach that you offer to people is not just a mortgage, but as, you know, really looking at the overall picture and giving them some, you know, some guidance or some vision for the future, which is been exciting for myself and for a lot of our clients that have worked with you.
Thank you. Yeah, no, I appreciate that. I will definitely take a unique approach looking at somebody's entire economic picture, what I call people's their personal or household economy, and really see how that home finance fits into that personal or household economy, because most Americans live on a monthly budget or an annual budget. So,
well, today we want to talk a little bit about down payments, just because we know there's different, we know back in kind of the mortgage, we'll call it meltdown time, we really had no down payments, which was part of the problem. And then we've kind of shifted. And so you'll hear anywhere from 3%, you hear 3.5%, 5%, 10, 20 or more. We just want to talk a little bit about, you know, helping guide people on, you know, what does it take to buy a house, you know, to get a loan. And we know there's different types, right? There's VA, FHA,
right.
Conventional. I know a lot of people refer to FHA as kind of a first-time buyer because it typically, a lot of times it is, but it certainly doesn't have to be. But maybe just talk about a little bit the down payment, and then we can get into a little bit of, you know, sourcing that and things like that.
Sure. The first thing I'll start off with, as we've talked about, and I think I've mentioned before, is the biggest misconception that I hear is that most people think they still have to have 20% down to buy a home. Most commonly I'll hear from first-time home buyers because maybe they don't have that experience, or they're learning from maybe parents, grandparents, somebody that's passed that information on to them. That is not the case. You can buy a home with as little as 3% down, 3.5% down. And in some cases, you don't have to put any money down if you can qualify for some assistance programs that are out there. Now, of course, if you're a veteran of the military or active military, the first loan with no down payment is going to be your VA loan. And by far, one of the best loans out there, underutilized as well by members of the military and veterans of the military because they're not educated on that program coming out of the military or serving in the military while they're there, is what I've found most frequently.
And that 20%, that mindset, it's just such a huge mountain to climb. And I think that a lot of people that have that misconception are just pushing off home ownership because it's, well, I can't do that because I can't come up with that much money down.
Sure. If you're talking average home right now is what, 350 to 400,000?
No,
Sorry, I need the realtors on this.
I sometimes wish we're probably up closer into that 450 range or so. I mean, things have really climbed. But I'd say kind of as a median in the area is somewhere in that range for a house, single family house.
I'll use 400,000 because the math's easier.
There you go.
Okay. So 400,000, to Scott's point, 400,000 with 20% down is $80,000. That's a huge mountain to climb.
Yeah.
It can seem overwhelming. It can discourage people from getting in the market, and then they stay either in a rental or that environment where those rents are increasing more than than interest rates are at this point.
Right.
I mean, they're accelerating at a rapid pace. So yeah, let's get that off the board right now, that you don't have to have 20% down to buy a home right now. The biggest ones with a little down payment is going to be your first-time buyer programs that you referred to. The first-time buyer program for Fannie Mae and Freddie Mac, the conventional bodies, is going to be 3%. That's it. If you are a first-time home buyer, meaning that you have not been entitled to a property within the last 3 years, you can put as little as 3% down on a home
So in
purchase.
that same scenario, we're talking $80,000 versus $12,000.
Absolutely.
So, and I think that's the first step for people, is realizing that this is what it takes to get into a home. And by the way, just look at what that payment would look like on that property, and look at what you're paying in rent for a lot of people. And it is really amazing how much things have changed and how much rents have gone up here in the Valley, to where homeownership is continuing to be a bigger, value. So saving up that down, we know there's some sourcing down payment we'll talk a little bit about too, sure. Just, where that comes from and things like that. But I think what we hear from the real estate perspective is that 20% down versus anything less. The big swing, I think, once you get to the 20% down or greater, is you get rid of what they call PMI, private mortgage insurance. So on that $400,000 loan, just ballpark range, what would PMI end up equating to ballpark? And I realize there's other factors, so I may not be able to give you I don't want to throw you a softball or a trick question here, but the same.
It wasn't a softball. It was more of a curveball.
I meant, yes.
But when you're talking PMI, if you're talking a $400,000 loan, private mortgage insurance with 3 to 15% down, because that's where you're going to see most people. I'm going to guess on a conventional loan product, let's call it, to be safe, $120 a month.
Right. So for some people trying to stretch, they go from 10% to 20% down in that same scenario. That's $40,000 to $80,000. The difference is $120 a month. You just have to decide, with that extra $40,000, what could you do with that money to invest in other places, or is getting rid of that mortgage insurance. The other thing too that we hear sometimes, and I hope you can clarify for me, is mortgage insurance. If you start with 10% down, but the equity goes up and you're paying money down, my understanding is you can apply then to have that mortgage insurance removed at some point once you get over that 20%. Is that still accurate, or is that out there? Or
it is accurate. Only on a conventional loan, though.
Okay.
So I'll get into the FHA body in a minute. But on the conventional loan product, let's say you put 10% down, your home appreciates in value. You can then either do one of two things. You've got at least 20% equity. So usually the sweet spot is 78% loan to value from your original purchase price, unless you're willing to pay for an appraisal on your own out of pocket and send it to the loan servicer. So again, it's 20 to 22% equity in your property, and then you can call your loan servicer and apply or request to have that private mortgage insurance removed without the cost of refinancing.
Okay.
Which could save you another $2,000, $3,000, $4,000, depending again on the fees that are involved.
Right. And so the big shift there is even if you put less than 20% down on conventional loan, at some point when you reach that 20+% in equity, you could look to get that removed at minimal cost, that type of thing. With an FHA loan, the MIP, the mortgage insurance premium, talk about that for a minute.
There's two facets with an FHA loan for a mortgage. And one of them is going to be the UFMIP, the upfront mortgage insurance premium, which is 1.75% of your purchase price, typically financed on top of your base loan amount, which helps discount your monthly mortgage insurance premium on an FHA loan. But it allows you, with a lesser credit score than typical 720 that we see ideally for a conventional loan, you can go down to 580, 620 on a FHA loan and only put 3.5% down payment and get pretty fair rate of mortgage insurance premium, but it doesn't eliminate. It doesn't go away when you reach that 20% equity in your home.
So it's there for the life of the loan.
It's there for the life of the loan. And that's a second misconception that I hear quite often, is that, well, I've got 25% equity in my home. My FHA mortgage insurance hasn't dropped off. Well, it's not going to. You have to refinance into a conventional product at Fannie Mae, Freddie Mac to get rid of that monthly MIP.
So it's possible you just have to refi out of your FHA loan into a conventional, but by the time you got 20% equity or so, a lot of times, and again, rates are dependent on what they're doing in the current market would affect that decision. But it is possible you just have to get out of an FHA loan because you can't get rid of mortgage insurance.
Can't get rid of it. Well, and I didn't mean to interrupt you, but one thing that Scott and I were discussing is when I help people get out of the FHA loan, is typically FHA will have a lesser interest rate on the 30-year fixed. So let's just say you got into an FHA loan at 3% on your 30-year fixed rate, but you've got the mortgage insurance. Typical is about $155 a month on a $300,000 loan. I'll just use that math for now. It's probably higher in a $400,000 loan for an FHA. So you've got 3% on your 30-year fixed, but $155 a month in mortgage insurance premium actually equates to about a 3.875% actual interest rate with the MIP. So even if you refinance to a conventional loan, and let's say you got 3.5%, you're still coming out ahead. And that mortgage insurance premium that you're paying on a monthly basis is going towards nothing but that mortgage insurance premium that you don't need any further. So even if your interest rate goes up, your payment will drop, and now more of your payment gets applied towards the principal of your loan,
which
helping
is
you
really
pay it
the
off
goal,
faster.
right?
The goal.
Yeah, that's the
Always.
tough thing about the PMI and the MIP is it doesn't correct your balance. It doesn't move you in a positive direction. It just allows you to have that loan with not having enough
Right.
equity to qualify for
It got you
a better
into
loan.
the home initially,
Yeah.
and now it's served its purpose. You can move on from it.
Gotcha. Well, let's talk just a little bit about sources of down payment. Obviously wages, but where are people getting their money for a down payment, or what are their options for a down payment?
Can I just come in with a sack of cash?
Which we've actually had that question before. Someone took
Or
a
a
picture.
wheelbarrow?
No, we actually asked someone for a prequal letter, and they sent us a picture of all this cash on a table that they had, and it's like, yeah, I don't think that's going to work, but it was a great try, but yeah, unfortunately. But no, we hear with down payments sometimes, especially as a dad, having kids myself, if I want to gift them some money to help buy a house, can I do that on any program? Or, what other sources do they have? I think if I remember correctly, when we bought our first house, I think I borrowed, if I'm not mistaken, against my IRA that I had and took some money out of that, and then you ultimately pay yourself back. But just share anything I'm missing there or any sources on down so that people kind of have something to aim for when they're trying to save up or look for options to get into home ownership.
Sure. And again, another misconception, number 3, let's call it, people believe that they have to have that down payment in their checking or savings. It's got to be liquid. It has to be sourced in a standard bank account. Not the case. You've already mentioned one source can be an IRA, a 401k. You can get a gift from a family member, a relative. It can be your second cousin Scott. It doesn't have to be a direct family member for most programs.
That's interesting. I didn't know that. Okay.
It can even be a fiance. So maybe if you are waiting to get married because of what we've experienced in the last 18 months with, the pandemic, and people are waiting to get married, but they know they're going to, is that you can get a gift from even a fiance under some program. So it doesn't have to be just mom, dad, that direct blood relative.
And how is
you can
that
get a gift.
documented?
That's where it comes in that the source that you're getting the gift from has to be able to source the funds as well. So that sack of cash, not going to work. But a bank account, their IRA, their 401k. So what we will typically ask for as lenders and banks is we're going to ask for that statement, whether it's a bank statement, a 401k statement, just as we would from the buyer directly. And then they have to sign a gift letter, basically just stating is that Scott's giving Steve this gift with no requirement for paying it back, because then of course we've got to add that back into debts, but that's all that letter.
There's a big difference between a gift and a loan.
Absolutely but that's what that letter serves, is to just provide that warm fuzzy in the file that we understand that it's a gift. It's truly a gift.
Gotcha. Well, and I would assume most people, it's their wages, right? I mean, they've been saving their money. That's how they're getting it down. But I'm assuming, there's inheritance. There's, unfortunately, parents pass away, things happen. So all those things, as long as there's a paper trail and it's documented of where that money is coming from. I mean, I think that's the big shift between, today and what got us in trouble back in, 05, 06, 07 was there's there wasn't a lot of down payments and there wasn't a lot of paper trails. Now it seems we went, kind of the other way. But as long as it can be sourced, it sounds like, and explained. And the good news is, by the way, I mean, we can cover all kinds of scenarios in the few minutes we're together today, but we know there's going to be, everybody's got their own situation. And so I think even listening to you talk about some of the math and the numbers earlier, the great news is that you're here and
right.
You can solve a lot of that for people and really, give them that clarity on what is the best decision, and not necessarily tell them what the best decision is, give them options and let them really look at what's the best down for them, based on how much down and here's what your payment looks like. Because a lot of people are like, well, for every $10,000, my payment only goes up X, but for that $10,000, I could pay off a car loan, I could pay off a credit card, a student loan, which effectively could make more sense.
Well, in this interest rate environment, let's just call it 3%. We've averaged right around 3% for the last year, give or take a quarter, we'll call it. But at a 3% interest rate environment, every $10,000 that you finance is about another $42 to $45 a month in payment. So on a $300,000 loan, that's about $1,265 a month in principal and interest. So if you wanted to put $10,000 less down because maybe you don't want to finance that new carpeting, well, you realize that your payment's going to go from $1,260 to $1,300. I bet you that's cheaper than the credit card for $5,000 or $6,000 getting financed from Home Depot.
Right. Yep. And that's the difference right now. I think the cost of money is cheap, and it's a big hedge against inflation as we're seeing it now, because you're getting, the big difference now too is we're getting fixed rates on stuff versus, back in the day, kind of those ARMs and the those kind of
creative financing.
They were gimmicks then, and yet I think I used one on my first house. It was like a 5-1, and honestly, for people who can manage it, hey, if you can get in and start building equity, that's the key. You just have to manage it and not take advantage of it.
Well, and I think that's the key of what we talk about, what I talk about when we meet with clients, whether it's, you, me, and or the other agents in the office, is we talk to the clients about what are their best sources. Because just to kind of go back in the down payment real quick, it can be from multiple sources that we discussed. So if you have X in checking, X in your 401k, and Uncle Scott is going to give us another 10K, I can use all three of those resources towards your down payment. It doesn't have to just be one or the other. It doesn't have to be the chicken or the egg. I can have the chicken, the egg, and throw in, the rooster to help somebody get into a home. And that's the key, because there becomes a cost of waiting, as we talked about, with houses appreciating like they are, not knowing what interest rates are going to do in the future. That can definitely be something that maybe that cost of waiting to do it now rather than waiting, 12 months when you've saved up X amount of dollars.
Right. Well, and I think one of the questions I had, is can you put too much money down? And that's a conversation that seems to be coming up a lot more right now. When we talk about just purely down payment money is, really everybody's situation is completely different. And so, somebody may have, an auto loan, an RV loan, a student loan, a credit card bill, and the difference of putting 10 or 20% down effectively versus wiping out with that other 10%, say a bunch of that debt, effectively that monthly cost. The other big difference, is with the mortgage is, and again, I would consult your tax person, but is that a lot of that is deductible, whereas some of those other loans are not deductible, the interest.
Right.
So, it's really having someone who can guide you through, not just put everybody in the same box, but, what's your goal? What's best for you? If you didn't have these things, we just had everything in a mortgage and we paid all that off, but you had a little bit of mortgage insurance, but that's what this looks like effectively a month. Or, you know what, guys, this is another good option for you. And then let people ultimately decide what's best for them.
Let them make that decision. And that's really what it's all about. It's guidance. It's education. It's allowing someone to make the best decision for them. And that, again, can be sometimes the struggle a little bit when it comes to finance, because people will try to get information from sources that not a true finance professional. And not a knock on, Aunt Susie or your coworker, wherever that may be, is talk to a licensed, finance professional, a loan officer, someone at the bank, someone that you trust, a referral from someone like yourself, whether it's me or anyone else. seek that advice from a trusted advisor so you can get the best education, the best information for you personally.
And what to do with your money.
What to do with your
down
money.
payment.
Absolutely.
Because I think that's, we're talking about down payment today. I think that's the big thing. If I think about a rental right now, I mean, a lot of just say a 2-bedroom rental could be $2,500 a month. Well, then you need a security deposit, and let's say it's another $2,500, and then whatever other deposits. I mean, you could be into this thing for, the first month, $5,000 to $6,000 or more. Mm-hmm. Well, going back to our $400,000 house scenario, you're halfway to a down payment at that point. And by the way,
which is equity.
Which is equity, right?
And write off and the other benefits. And you also don't have a payment that first month. We can talk about that later in interest. But the point is that, boy, if you're halfway there, is there a parent, a grandparent, someone who could gift you the additional to really change the trajectory of your future, because now you're starting to build wealth through real estate versus build wealth for somebody else with their real estate.
And to go to your point, because you mentioned it, when you bought your first house, you took money from a retirement vehicle.
Yep.
And you diversified your portfolio by investing in a home. And that's the other thing. So if you're halfway there by not putting down that security deposit or first month's rent, and you have $5,000 or $6,000, well, the stock market's done pretty well the last few years. Maybe you have a little bit more in your 401k or IRA than you thought, that maybe you could take that $5,000 or $6,000 from there to help you get into the home for that down payment that you need, rather than, again, waiting another 6 months to save, or renting and signing a 12-month lease that you're waiting that out as well.
Well, yeah, and you're just paying off somebody else's mortgage, and if that makes you happy, then I guess go for it. I've got several rentals, so let me know. But
how does qualifying look? You've been doing this through a lot of different markets,
right?
So how does qualifying look today versus a few years back? If somebody did this a long time ago, or maybe they were scared off of that last crash, if you will, how does qualifying look different?
It's more highly regulated is the word that I'll use, the proper term. But basically, there's no exotic products. There are, but they're not your everyday products. Those are the non-qualified. That's a fringe product. Everything now today is very cookie cutter. As a friend of mine always says, is like, we're all selling the same bag of sugar. It's really just, you need W-2s, you need pay stubs, you need bank statements, you need 401k money, assets, you need good credit, all of those things. And it has to be sourced. It has to be documented. So it's a different environment from where we were from, let's say 2000 to 2008, that 7-8 year stretch, that it's now gone the complete opposite of where we were then, to where, cross every T, dot every I.
Well, I think there's a lot of takeaways from today. One of them that I would say is, a lot of people spend a lot of time trying to figure out the how, when really they just need the who, right? The how is overwhelming if you're going to work. It's not your profession to know what are the options for down payment. How do these affect me? But if you can find the who, like we have in you, meaning having someone who does that full time, they can take all that off your plate and really guide you through all your options. And I think a lot of people spend a lot of time on the how. How am I going to do this? How am I going to say, where do I get the money? And not realizing that they may already be in that position, or at a minimum, they do a consultation and they get clarity on what they need to do then to hit their target. And so I think finding that who in their world is more important than the how, because the who will help them figure out how to put this together, how to structure it.
And having somebody local that is solution based versus going to the big box banks and who knows who you're talking to.
Well, there's a lot of fine lines in a lot of those ads you see on TV and radio, and that you can't read, and that move so quickly across the screen, that we've been on the wrong end of those deals more times than not, where they overpromise, underdeliver, and the best you can do is call an 800 number and try to get somebody, versus having somebody who's in the market who you can walk in face to face, still have conversation. Because the difference is there's a lot of things that tech are great for, and they're creating a lot of opportunities out there. But when it comes to buying and selling real estate and financing real estate, this isn't something people do like taking an Uber or booking a hotel room or taking a flight, where that's more transactional. This is like most people can count on one hand how many homes they've owned in their lifetime. So it is a big decision. And so having a qualified professional to guide you just on simple stuff like down payment. I mean, you may think, I want to put as much down as I can, and that may or may not be the best decision. If rates were at X, maybe more down makes sense. If rates are at Y like they are now, it may not make as much sense, because you could take some of that same money and put it into, a Vanguard index fund, or you could pay off some other debt, or buy another investment property, quite honestly, and have two properties appreciating. So I think it's, my just from listening today too, is just that consultative approach, that you guide people through their options, and they don't have to be overwhelmed by, how do I do all this? We just sit down, do a consultation, and then guide them through, here's what's next, here's what you need to save. If you have someone you can reach out to, if somebody wants to help you with that, with the gift or things like that. So there's a lot of options that people don't think of. And that's been really, when we were teaching in-person classes before all the COVID, it was amazing, some of the just like lights that went off, like, whoa, okay, I didn't think about that. Right, that's not your role, that's our role, or your role is to help them uncover opportunity.
Absolutely.
Yeah, and I've seen a lot of ahas with people too, that they think, oh, it's not the right time for me. And so they put off meeting with a mortgage professional until it's getting closer to their time frame. And well, it's never too early to meet, because you're going to identify some opportunities to shave down that future rate by, saying, here's what to pay off, here's what not to pay off.
That is a great point. It's never too early to start. If your goal is home ownership, schedule a time to meet with me or call me now, because then I can put you on that path. Because maybe it's not a year away, maybe it's only 90 days away. Maybe it's a lot sooner than you think. And that's another misconception that people have. It's, again, finding out the who so they can learn the how, getting into a home. And that's what I love doing.
Well, we've had people, it's interesting. It made me think of, we've had people who are like, well, I don't have the down right now, so I'm going to have to sign another year lease and wait another year. And then they don't do any preparation in the meantime, or they don't think it through. Whereas if we sit with them, we can go, hey guys, yeah, you know what? It's going to take another 6, 7 months or 9 months. This is going to happen. But let's look at, maybe signing a lease where you can have a clause in there that if you end up buying a home, that you can get out of your lease. Or there's other terms that we can try to help you with, so you don't feel like you're trapped, or that you've just signed a lease that maybe you don't have some flexibility, or at least maybe you only need to sign a 6-month and then try to go month to month. And I realize in a tight market, some of those options go out the window. But the point is, we're always looking for solutions of what has to happen to cause this to happen. And a lot of people try to figure it out on their own. And I don't know about you guys, but I didn't learn about money and about assets and equity and liabilities and the value of home ownership, not just from the tax standpoint, but how it makes you feel and behave when you're filling out a form, you're checking own versus rent, and just all the value that goes with that. And I think one of the limiting things, and why we picked down payment as a topic today, is because that is a limiter for a lot of people. We wanted to try to really look and say, guys, there are other options out there, and there's probably stuff we're not even thinking of right now that we could do once we saw somebody's whole situation. It could help guide them. And by the way, there's no cost to do that. Just come get educated. At a minimum, you're going to feel better about what you're doing next and where you and your family is headed.
That's the best part of it. It really is. And again, giving people that education, so that, to Scott's point, maybe if you are 6 to 7 months out, there are a few things that I can educate you on to improve your position when 6 months happens. So maybe you're not in an FHA loan anymore. Now you're in that conventional loan where you can get rid of the PMI and you don't have that upfront mortgage insurance premium. All those things that we talked about, I can kind of give you that guidance to move you toward that goal.
Yeah, Steve, it's been a plethora of knowledge today, so I appreciate that. I hope you'll be able to make it back with